Okay, good afternoon and welcome to our options education webinar series. My name is Tony Zhang. I am the chief strategist here at OptionsPlay. And today we're here to talk about a strategy for those of you that know who I am on CNBC are quite familiar with, which are credit spreads. And I want to talk to you about the 4 rules that we have in terms of how you can generate consistent income using this particular strategy. Not only am I here to try to teach you about best practices for what is one of my favorite strategies, but also how you can utilize this strategy, especially if you're brand new to options trading or starting out with options trading, to help you build your confidence, because it's a very forgiving strategy. It's a strategy that really is quite flexible, especially if you don't have a strong directional view. You can use in many different scenarios. So I want to break down this strategy for those of you that are still learning. Make sure you understand it, understand best practices, and then more importantly, show you the tools that we have built here at OptionsPlay that helps you analyze these strategies and helps you find opportunities the same way I find them on CNBC. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So what we'll do is we'll take a look at, starting off, we'll take a look at what are credit spreads. And what I'm going to do is I'm going to give you a bullish example of a credit spread here today. We're going to look at an example that is applicable to the current market conditions. We're not going to look at bearish trades just because we don't have enough time. But if you can understand the bullish example, the bearish example will simply be a mirror image of it. So it'll be fairly simple to understand the opposite. Then we'll talk a little bit about what are the optimal credit spreads, meaning how do you find credit spreads that give you some form of an edge, and how to find that options edge is what we're going to explore here today. The tools that we have available at your disposal to help you find trades that give you that edge. Then we'll talk a little about the real-time credit spread signals that we offer here at OptionsPlay, and then conclude with the 4 rules for trading credit spreads. What are the 4 rules that you cannot break when you sell credit spreads? And then lastly, I want to talk a little bit about how you can take all of this in conjunction with each other and what you can do to really help build your confidence in options trading. So before we get started, I do want to launch a quick poll here. I want to first get a sense for the audience here in the room in terms of how much experience do you have with trading options. So please answer the poll here on your screen, whether you're just getting started, whether you've been trading for a while, or you're a very experienced options trader. Okay, so it looks like from almost 80% of you have voted already, and the vast majority of you are. I would say that we have a fairly wide spectrum here. More than 2/3 of you say that you're either just starting with options trading or you've been trading for a while. 18% of you say that you're just getting started and learning, and 11% of you say you're very experienced. So with the exception of the 18% of you that are saying you're just getting started, for most of you here that are attending, you probably have come across a credit spread at some point. So today what we're going to do is we're going to really dive into this particular strategy and understand why it's a strategy that's really suitable for so many different parties, regardless of what your experience level is. And for the 18% of you that answer that you're brand new and just getting started, hopefully this strategy or what you're going to learn from today's session inspires you to use this strategy as one of your core strategies to help you build your confidence and build your starting point when it comes to options trading. Okay, and I do have a second poll here. I do want to ask how many of you have already traded a credit spread before? So either yes, I've traded a credit spread, no, I have not, or no, I am not sure. Okay, so it seems like about at least 70% of you, 2/3 of you have traded a credit spread. 1/3 of you have not traded a credit spread before, and about 4% of you say you're not sure, meaning you're probably new and you're not quite sure about the names of some of these strategies. Okay, so I would say the majority of you have traded a credit spread. So what we're going to discuss here is unlikely going to be new, but hopefully it will be new in terms of the rules and how to seek the optimal credit spreads. If you have never traded a credit spread before, hopefully this gives you a template to help you understand when you do, how do you go about doing it? And then for those of you that say you're not sure, hopefully this helps answer those questions as to perhaps whether or not you have traded one of these strategies. So those are the things we're going to go over here today. And what we're going to primarily help you answer from today's session is how can I generate consistent income with optimal credit spreads and build confidence in my options trading strategy. And the goal here, again, is not just to generate consistent income, but more importantly, how do you build your confidence? Because I see a lot of investors who, have been running income generating strategies for a while, but then occasionally you see these huge blowups in their portfolio. And what we really want to talk about is how do you prevent those blowups and how do you make sure that you're confident in your strategy in the long run? And if anyone can relate to that in terms of not feeling confident with their option strategy, please type yes into the chat window. So there's a chat window at the bottom of your screen and a Q&A window. Both screens you can have up and running. Please type yes into the chat window if you can relate to this idea of trading options, but not quite feeling confident about your strategy. And during the session, if you have questions, feel free to type it into the Q&A section. I won't answer any questions live during the session. I will keep an eye out here on the chat window. But if you have questions, I do have a team here that's going to help answer some questions during the session. And at the end, I will take your Q&A and answer your questions there. So I see a lot of yeses so far. So, it really comes down to the fact that I've been doing this for about 15 years. And as a technical analyst and a market strategist, I have worked with thousands and thousands of retail and institutional customers. And I have seen just about every single possible strategy under the sun with respect to technical strategy, option strategy. And I have heard many different viewpoints as to how to go approach options trading. And today, what I want to share with you is one of my favorite strategies and why I use it so much in helping myself trade and as well as helping other investors build confidence in their options trading. So, and for those of you that don't know who I am, one of the great ways, in my opinion, to get more exposure to options trading, 18% of you said that you're brand new to options trading. 33% of you said you've never sold a credit spread before. Well, you can watch me do these with real trades on Options Action every single Friday at 5:30 p.m. on CNBC. Me, Mike, and Carter, every single week, we lay out 3 trades for you: a stock or ETF. We'll tell you whether we're bullish or bearish on that stock or ETF, why from both a technical and fundamental perspective, and show you, more importantly, how to leverage that view using options. And the key here about using options to take our directional view comes down to the fact that options allow us to control our risk. And I'll talk a little bit about why that's so important and why that's one of the critical elements in my 15 years as a market strategist that consistently lead to successful traders are the ones that manage their risk properly. It's a lot of people think that the best traders are the ones that can time the markets the best, or the ones that are sitting in front of their screens all day and can read the markets. Those are not the best traders. The best traders are the ones that manage their risk the best. So we're going to talk a little bit about how this particular strategy and the rules that I'm going to show you today can help you achieve those risk management goals that I see are instilled in some of the best traders on the street. So let's start by talking a little bit about just what is a credit spread. It's a strategy that we're going to do a deeper dive into, but at a high level, it's an income generating strategy that gives you that you can use whenever you have what I call a mild directional view on a stock or ETF, meaning there are some stocks that you just have a general sense that they are going to drift higher here. You don't necessarily need to have a strong directional view, meaning you don't have to believe the stock is going to rally substantially over the next few months or next few weeks. Maybe you think it's going to drift a little bit lower because the direction's heading in. All you need is a mild directional view. There are other strategies where you need to have a very strong directional view, like such as buying a call option or buying a put option, where you have to believe the stock is going to make an outsized move to either higher or lower. A credit spread is not like that. A credit spread is just, you have a general mild view. You can actually be somewhat wrong in that view and still be profitable. And that's why it's a strategy that a lot of investors who are starting out prefer, because it's what I call a very forgiving strategy. So if you're right on the direction, you'll profit. If you're wrong on the direction, you still have an opportunity to be profitable. So it's a very high probability of success trade. And I think this is part of what helps, especially when you're new, building that confidence. And it's so important to just feel confident that you have the ability to win at least 50% of the trades that you trade. But the third most important part about a credit spread that's very important, regardless of whether you're experienced or new, is the fact that it has limited risk and has limited reward. And when you enter the strategy, you know exactly how much you can potentially make and how much you can potentially lose. This helps you plan for the best and worst case scenario, meaning you're not getting into a trade and then figuring out how much you can potentially lose. You know exactly how much you can lose, how much you can win. And for those of you that are planners, and I encourage, for the best traders are always best, they're very good at planning, is to know that plan. And when you're able to know your plan and trade your plan, those are the ones that are going to be most successful. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Perfect. Okay, so at a high level, that's what a credit spread is. Let's now dive into an actual credit spread. We're going to break down an actual credit spread, and we're going to come back to why we use this particular credit spread. So we're going to use Cleveland Cliffs. Someone actually tweeted this us on the show a couple of weeks ago, and this is one of actually a stock that I had not known a lot about until just maybe a month ago. I was looking into this stock. It's actually one I think that I really like from a technical and fundamental perspective. Recently broke out above a $22 support resistance level, came all the way back down to test it as support, and has the opportunity now of bouncing higher here. So I don't necessarily have a strong directional view, but it recently broke out above resistance level, came back to test it as support. My general view is that it can continue to drift higher here. So a really prime example of selling a credit spread. So in this particular case, what I'm going to use is a weekly option. A weekly option. I'm going out to July 30th, a weekly option, which is roughly 45 days from expiration. And I'm selling the $23 put option. The stock's currently just around 23. I'm selling an at the money put option, collecting $2.64 to sell the put option. Now, for those of you that are familiar with selling puts, selling a put option collects a fair amount of premium. But what happens with selling a put option is that you have truly quite a bit of risk to the downside. If the stock continues to tumble lower and lower and lower, you have risk all the way down to zero. So a credit spread, what you're doing is you're simply selling a put option, and then in order to reduce the amount of risk that you have to take, what you're doing is you're buying back a lower put option. In this particular case, let's say a $19 put option, and let's say I pay 82 cents for it. What that does is it turns what is a strategy that has fair amount of risk down to a strategy that has limited risk. So it has limited reward and limited risk. And here, because the difference between $2.64 that I collect and the 82 cents that I pay, the net credit that I receive for the total strategy here is $1.82. Okay, so I'm collecting $1.82, or my max gain here is $1.82, and my max risk here is $2.18. Now, how do I figure that out? How do I know the max gain versus max loss? We're going to dive into this a little bit later, but really it comes down to the distance between the two strikes. So the distance between the 19 and the $23 put, that's $4, the distance between the two. When you subtract $1.82, which is my max gain on the particular trade, that's how much I'm collecting. The rest of the $4, that's my max loss. So what you're going to learn here during today's session is how do we find credit spreads where the max gain is as high as possible, because whatever we gain, the rest of it is our max loss. So the higher our max gain is, the lower our max losses. And it's all about trying to find credit spreads that give us this particular type of edge. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. And Gopa, that's correct. This is what is traditionally called a bull put spread, or sometimes considered a short put spread, depending on what platform you trade on. Different platforms call it different strategies. So let's look at this particular strategy, right? I sold the $23 put. I bought back the $19 put. There's three numbers that we really have to keep in mind of when we sell a spread like this. First of all, just looking at the chart, this is a stock that's clearly on a strong uptrend here. But like I said, what I was looking at earlier today was the fact that it recently broke out above this $22 level, came back to test this level as support. And my view is that it's just going to continue on this general upward trend. I don't really have a good timing on it. I'm not really particularly interested in saying that this is going to reach a certain price by a certain time. I just have it's got a strong technical chart here. It's got good relative strength. And, fundamentally, this is a stock that I really like. I'm not going to get into all of that, but this is a stock that, someone tweeted us a few weeks ago on the show, and I looked into it actually a few weeks prior to it and really liked it. And it came up on one of our scans today. I'm going to show you how to access it. But when you sell a credit spread, there are three numbers that you really need to pay attention to. The two strike prices, which are the $19 and the $23, and the break-even point on the strategy, which in this particular case is $21.18. Now, just to give you a sense, $21.18 is $23, the upper strike, minus $1.82. Once you take $23, the upper strike, minus $1.82, that's how you get $21.18. So those are the only three numbers that you really need to pay attention to on the chart. And those are the three lines that I have drawn here on my chart. So this is the stock price, the historical stock price. And I have one line drawn at 23, one line drawn at 19, and one line drawn at $21.18. So this is my upper strike price, this is my lower strike price, and this is my break-even point. So once you sell a credit spread, the stock price can go anywhere, right? It can go higher, it can move sideways, it can move lower. And the question is really, how much can you potentially win? How much can you potentially lose? And understand, when you win and when you lose, because that's really the key of any good option strategy, is understanding your risks and rewards and trying to maximize your potential rewards whenever possible. So if the stock is above $23, when you sell a credit spread, if the stock stays above your upper strike price, you will make the full $184 profit. The $1.84 that I'm collecting multiplied by 100 shares, that's my full profit. Okay, does that make sense? Please type 3 into the chat window if that makes sense to you. As long as the stock stays above my upper strike price, I make my full profit. Now, let's say at expiration, the stock doesn't move any higher. Let's say it moves a little higher, moves a little lower, but at expiration, it's still at $23. How much money do I make if the stock is still at $23 at expiration? If anyone has the answer, please type it into the chat window here. Malcolm is the first to answer that question correctly, $184. So this is what I mean by about the strategy being forgiving, meaning even if the stock doesn't move in the direction that I expect it to, it just moves sideways, I still make my full profit here. So in the first scenario, if the stock goes in the direction I expect it to, I make my full profit. If the stock moves sideways and just doesn't move at all, I still make my full profit. Now, let's say the stock starts to move against me. The question is, how far does the stock move against me? Because if the stock moves a little bit against me, let's say between 21.18 and 23, guess what? I'm still going to be profitable. So what that actually means is that I can be wrong on the general directional view and still eke out a small profit on this particular trade. That's the forgiving nature of this particular strategy. And only if the stock declines below $21.18. Now, at this point, if the stock is down here, I would say that my thesis that this stock is a strong stock that will continue on its uptrend is clearly wrong. But even if it declines down between $19 and $21.18, I will lose somewhere between $0 and $216, which is the max loss. Okay. So at that point, if I'm just completely flat out wrong, so 1, 2, and 3 will give me a profit, 4 will give me some loss, and only if the stock completely declines below the lower strike price of $19 do I have the full loss of $216. Now, even if the stock goes to 0, my max loss here is only $216. No matter what happens, I cannot lose more than $216 as part of this strategy. Does that make sense to everyone? If that makes sense, please type 4 into the chat window. So out of these 5 scenarios, 1, 2, and 3, I will be profitable. 3, not as profitable as 1 and 2, but I could actually be wrong on the direction and still be marginally profitable. 4, where I'm pretty much wrong on the trade, I'll lose some money. And on 5, that's when I have the full loss here. So the trade-off that you make with this forgiving strategy, meaning a strategy where you're going to be more likely to win than to lose, is the fact that what you can potentially make, $184, is always going to be less than what you can potentially lose. That is the trade-off that you make with any high probability strategy. Any strategy that has a probability of profit greater than 50% will always have more risk than you can potentially make. So that's really the trick here, is how can we find strategies like credit spreads where the ratio of max gain is as high as possible relative to our max loss. That's the whole challenge here. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. So let's discuss about when credit spreads are used, because I showed you a credit spread, but what I want to talk a little bit about are when should you use a credit spread, right? I set you up with an example, but if you're looking for opportunities on your own, how do you find stocks that are optimal for selling credit spreads? This is really where near support or resistance levels are good starting points. So when you have a stock that's trading near a support level where you have multiple support levels, those are good times to sell a credit spread, because as long as the stock moves higher, it doesn't matter whether it moves a little bit higher, a lot higher, or it just moves sideways and holds the support level. All of those scenarios will be profitable. Overbought and oversold conditions. If you look at a technical indicator, when a stock is oversold, those are opportunities to sell a credit spread. Those are likely reversal points. As long as they reverse, doesn't matter if they reverse by a little bit or a lot, credit spreads are going to be profitable. Or trading ranges. Once you've established that a stock is within a trading range, you can trade the top of the range by selling a call credit spread, trade the bottom of the range when it creates a put credit spread, and you can do this over and over again, selling a credit spread once you've identified a trading range. So it's important that you think about direction when you're selling credit spreads, because I know there is going to be some investors here on this session today who is going to say that they sell credit spreads, but only doing them when it's in a high volatility environment. How many of you relate to that, or how many of you currently do that, where you only sell credit spreads in a high volatility environment? Please type yes into the chat window if you use credit spreads only in a high volatility environment. And I see quite a few yeses, okay? And I'm good friends with Tom Sosnoff, and I know he's been teaching this for many, many years, but this is one of my gripes with him about high volatility. While it is true that high volatility environments, generally speaking, provide better conditions to sell credit spreads, it's by no means the only conditions that you should be looking at, because your directional view should still have a far bigger factor in the decision to sell a credit spread. So today what we're going to do is we're going to talk a little bit about these high volatility environments, and we're going to talk specifically about volatility skew. And we're going to talk about that in the sense of how you can find them. More importantly, we're going to show you how our tools help you actually create them. So just to talk a little bit about the optimal credit spread. The optimal credit spread, based on our back testing, going over thousands and thousands of trades, testing different expiration dates, different strike prices, the optimal credit spread is going out 45 days to expiration. So that's why we've chosen the July 30th weekly options, which is 45 days to expiration, selling an at-the-money call or put, and buying back a 25 delta call or put. So an at-the-money is about a 50 delta, and out of the money about a 25 delta. And the rule of thumb here is that you want to collect at least 1/3 of the width. The key here is to actually try to collect more than 1/3 of the width. And we're going to discuss why that's so important in trying to collect 1/3 of the width. And when you're able to collect more than 1/3 of the width, what that means for your bottom line. So those are the things we're going to discuss here today. But the optimal credit spread, 45 days, sell the at the money or the 50 delta call or put, and you want to buy back roughly about a 25 delta call or put against that. With those rules, you should be able to collect roughly about a third of the width. Sometimes, occasionally, you will be able to find closer to 40% of the width. And we're going to show you how to find those strategies. Now, I know some of you were asking me about these charts and how to access a platform that provides these types of graphics for you when you have an opportunity. So for those of you that are looking to check out what we have to offer here before we jump any further, I do want to show you how you can sign up for a free 30-day trial to OptionsPlay using the link here on your screen, which I just posted into the chat window here. It's a free, fully functioning 30-day trial to the OptionsPlay platform that will allow you to take any symbol, type in a credit spread, and be able to see graphics like this: max reward, max risk, probability of profit, break-even prices, and be able to see the graphics like this. Some of you have looked at these graphics on Options Action and asked how to replicate them. Our platform allows you to do that. So you can do it using the link here on your screen at using the link here that is posted on your screen. So to look into this a little further, right? To dive into this and show you how to utilize credit spreads that give you an edge, we really have to understand the relationship between risk and reward. Because a credit spread has defined risk and defined reward, the distance between the two strikes dictates what you have to play with. So if I'm selling a $100 call option and I'm buying a $110 call option, the distance between these two strikes, which is $10, dictates the total amount that's at play. So what you're trying to do as an option seller in a credit spread is to try to collect as much income as possible, because whatever you collect in income, the rest of it will be your risk. So if you collect 1/3 of the width, which is $3.33 on a $10 wide credit spread, then your risk is going to be $6.67 or 67% of the width. So the reason that we tell you to try to collect 1/3 of the width is because when you collect 1/3 of the width, for every $1 in potential reward you collect, you're going to be risking roughly $2 on the back end of that. Now, when you collect $1 in potential reward while risking $2, you need to have about 67% of your trades to be winners in order for your strategy to break even. So two out of 3 trades needs to be winners for it to offset any losses. As you can see, this would basically be a break-even trade, right? So if you kept doing these trades where every 2 trades you won $1, every 3rd trade you lost $2, you effectively at the end of this would break even. Now, breaking even is not what we're trying to do. What we're trying to do is be profitable, be better than break even. And that's why occasionally when you look in the markets, and if you know where to look, what you're going to find is that sometimes there are some pricing inefficiencies. Sometimes you're able to sell a credit spread where you collect more than 1/3 of the width. Sometimes on a $10 wide credit spread, you find you're going to be able to collect closer to 40% of the width. And that might not seem like a whole lot, but if you are able to collect 40% of the width, that reduces your risk from 67% down to 60%. That means for every $1 in potential reward you collect, you're risking only $1.50. And that reduces your number of trades in order to break even down to 60%, which means that if, let's say, you have 2 winning trades at $1, 1 losing trade at $1.50, 2 winning trades at $1, 1 losing trade at $1.50, and you continue this cycle over and over again, you have a positive expected return. So this is the goal that you're trying to achieve when you're selling credit spreads. You don't want to just sell credit spreads when implied volatility is high. It doesn't really matter whether you're in a high or low volatility environment. I'm going to show you why. As long as you're able to find this skew that works in your favor, that's going to provide you with the edge that you need in order to be profitable selling credit spreads. Does that make sense to everyone? Please type 6 into the chat window if that makes sense to you. And many times, if you go back and watch some of the trades that I've made on CNBC selling credit spreads, you'll see me refer to percentage of the width. And many times the trades that I'll make, I'll refer to the fact that I'm collecting 37, 38, 40% of the width. And this is what I'm trying to achieve. I'm trying to collect 40% of the width. And when I'm able to collect 40% of the width, which is generally speaking the higher end, occasionally you find 41, 42%, but those are pretty rare. I would say 40% you can find fairly consistently in the markets where you're collecting. For every $1 you collect, you're only risking $1.50 on the back of that rather than $2. And lastly, I want to bring this up because some investors I have seen prefer selling instead of trying to manage risk to reward, they manage probability. They manage the other half of the equation. I see a lot of investors will sell these really far out of the money credit spreads. And if any of you have ever done that, please type 7 into the chat window. If you've ever sold these really far out of the money credit spreads that have very high probability of profit. Now, here's the thing about this, is that when you sell these really high probability of profit trades, what you're doing is you're collecting a very small amount of income in exchange for a large amount of risk, which means that you need about 90% winners just to break even. I see this a lot of investors doing this, and they do it because of this 90% probability of profit. I see a lot of investors will say, I want high probability of profit. It doesn't really matter what the risk or reward is. As long as I win 90% of the time, I'll be happy. I'm curious to see, for those of you that do this strategy, how many of you are truly successful at it and in the long run, because we've tested this strategy for a long period of time. And we call this picking up pennies in front of a freight train because most of the time you win, and you're winning small amounts, and you think you're really happy collecting $1 every single month. And you say, this is consistent income. I'm really collecting income, but it's really not consistent at all, because the one trade out of a blue moon that goes against you will wipe out months, sometimes years of income in a single trade. So you can call it consistency until it doesn't work. So this is really one that you have to be careful of. And we tend to find that trades that have 90% probability of profit usually do not have 1 to 9 risk to reward ratio. It's usually closer to 1 to 20, $1 to $30 in risk to reward ratio. So that even that 10% chance that it wipes out, it usually doesn't just wipe out $9, it usually wipes out $20 or $30 to the downside. So this is, again, what we call picking up pennies in front of the freight train. And in the long run, the success of this strategy is completely dependent on luck, meaning what year you started selling this strategy. For those of you that were lucky enough to start this in 2010, you were largely fine for a fair amount of time. And maybe you've gained enough income since then to offset some of the big losses that came in 2018 and 2020. But for those of you that started the strategy in, let's say, 2019, you would have lost your shirt in 2020 on this. So it's all pure luck down to when you start, and whether you start in the beginning of a strong business cycle without any major corrections, or you happen to start this just right when there is a major correction and you effectively blow up your account doing so. So be very, very careful looking for credit spreads that have high probability of success. What you're far better off doing is finding ones that have good risk to reward ratios, because even if you have a bad trade, the most you can wipe out is the last 1.5 trades. That's the most you can wipe out. Even in the worst directional play you've ever had, you'll only wipe out 1.5 previous trades, not a previous few weeks or 3 months worth of work. So going back to this high volatility environment, right? So a lot of investors have been taught over the years to sell credit spreads when vol is high, buy debit spreads when vol is low. And while that as a generalization is generally true, it's far more nuanced than that, because this Cleveland Cliffs trade that I collected $1.84 on, so $1.84 on a $4 wide credit spread, $1.84 on $4 is, let's see, what is that? Just about 40%. 184 divided by 400 is actually 46%. So we're collecting a significant amount of the vertical spread. Now, is that because the implied volatility on Cleveland Cliffs is really, really high? The answer is no. It comes down to the skew, the difference in terms of implied volatility between the 23 strike and the 19 strike that I'm selling. As you can see, the 23 strike has an implied volatility of about 80%, and the 19 strike has an implied volatility of about 70%. So there's a fairly large delta between the implied volatility on the strike that I'm selling and the strike that I'm buying. That's far more nuanced than what IV rank or implied volatility percentile is going to tell you. Implied volatility percentile is telling you, the generalization of the at the money 30-day options. That's not going to give you any sense for skew, and it's certainly not going to give you a good sense for what you can get. Because if, let's say, you sold the 22.5 and bought the 18.5, guess what? This edge that I just found from the 23-19 put spread doesn't exist if you moved it half a strike down to the 22.5, 18.5 strike price, because the implied volatility skew is actually flipped in this particular case. So it's far more nuanced in terms of finding these opportunities. Higher or low implied volatility rank is not going to help you find these. You really have to look at volatility skew. Now, the problem with volatility skew is that no one stares at volatility skew charts. No one sits there and says, oh, let me find the biggest opportunity between the 23 strike and the 19 strike and looks for these inefficiencies. And that's really where OptionsPlay comes into play, because we actually scan the markets in real time for all of these inefficiencies and give you reports that tell you when there are credit spreads that give you this type of opportunity. So we found this earlier today when Cleveland Cliffs was trading at 23.20, where you can sell the 23, buy the 19 for $1.94. So it was actually even higher earlier today at about 2:22 p.m. when we ran this report last, and we were collecting 48% of the width. Like I said, over 40% is pretty rare. And sometimes you might find that you might not be able to get executed at 48%, but as long as you're able to get close to that, that's what you're doing. So what we do here in our credit spread opportunity report, number one, we filter only for very liquid symbols. So no stocks on this report you will ever have trouble filling an order near the midpoint. These are trades that are meant to be, that can be filled at the midpoint, if not exactly on the midpoint for these particular trades. And we're looking for credit spreads that collect a minimum of 1/3 of the width. But as you can see, almost all of the trades collect significantly more than 1/3 of the width. We're trying to find this skew in your favor. And lastly, what we also do is look for directional edge. So if you find a very strong bullish, let's say I find a credit spread on a put spread that has very strong risk to reward ratio, but we have a bearish view on it, that doesn't do us any good. So we really line up all three things. The fact that something is very liquid, so something that has a tight bid-ask spread, that has a fair amount of open interest, that we know that we can trade that at the minimum, at the midpoint, at collecting at least 33% of the width and collecting that directional edge. And this is updated for you every single hour. So you have symbol and direction, so you know what stock it is, whether it's bullish or bearish, what the current price of the stock is. We tell you the credit spread details, which strike to sell, which strike to buy, and what expiration to use. The risk to reward of it, which is how much of the premium you're collecting as a percentage of the width. The higher the premium you collect, the less the risk you're taking. So what you're trying to do is just maximize your reward and reduce your risks. And then what we have is also volatility and earnings. Very important. You want to look, for those of you that like to use IV rank, you can see the IV ranks of each individual stock. As you can see, a lot of these have very low IV rank. And a lot of investors will say, will not even bother looking at some of these stocks because they have low IV rank. Yet, something with a low IV rank like FCX, 5% IV rank, I'm still collecting 37% of the width. That's a fair amount of the width that you're collecting. It doesn't report earnings for another 37 days, or Take-Two doesn't report earnings for another 48 days. So I know I don't really have an imminent earnings coming up. I can avoid that. Really important items to pay attention to when you're selling credit spreads. And then what we have is a link that you can click on to open this trade in OptionsPlay, so you can instantly execute, so you can instantly analyze it using this platform that I was showing you here. All of this is updated hourly for you. So I'll just show you this real quick. Here is the credit spread report. Let me see if we have an update to the credit spread report. So here's the credit spread report right now. Cleveland Cliffs is still on this, trading at 22.85, selling the 22.5 19s will collect $1.43 on a $3.50 wide credit spread. That's 41% of the width. So let's take a look at Cleveland Cliffs based on the current price. So these are based on closing prices after the close, but let's take a look. So this is selling the 1922.5, which collects $1.42, but now this is a $3.50 wide credit spread. So $1.42 on 3.5 is a little over 40% of the width. So I'm collecting $1.42 on a $3.50 wide credit spread. So exactly selling the at the money strike price. So we're selling the 22.5 because it's now trading down to 22.86. But this credit spread file is updated every single hour and finds these trades that provides you with that edge. And you can click, whoops, I did not mean to do that. How do I make this bigger? There we go. And you can click on any trade on this list, click on it, and it will bring it up within OptionsPlay so that you can view it with the analytics. What is your max risk? What is your max reward? And what is your break-even price? So that you can see, and you can type in your outlook, right? So maybe you think the stock's going to stay around $23. You can type that in and see what your potential risk is. You can think if it goes down to 18, what your potential risks are. You can look at the Greeks, or you can compare it to other strategies here as well. You can say, well, what if I bought a call option or bought a debit spread and the stock went higher? How much do I potentially make? How much do I potentially lose? You get all of this as part of this platform. So it helps you find the opportunities here and then helps you analyze it. You can look at the trade on its own. You can compare it to other strategies. And this is all part of your free 30-day trial. So again, for those of you that are brand new to OptionsPlay, if you want to check out a free 30-day trial to access all of these tools, the trading report, the platform itself, we have plenty of education and to help you learn more about these types of strategies. You can sign up using the free 30-day trial link on your screen in the chat window here right now. So with that, let's go over some of the rules. Now that we've talked about the strategy, we explained to you the strategy, we explained our rationale behind how we find credit spreads that give you an edge. Let's talk a little bit about once you sell this credit spread, what are the rules to generating consistent income? So the first rule of thumb, right, is to follow the best practices for entering these strategies, which are selling the 45-day, selling the 50 delta, buying the 25 delta call or put. And what you should only enter credit spreads that collect at least 33% of the width. If you're collecting less than 33% of the width, that is not a trade that you should make, because that means you're risking more than $2 for every $1 in potential reward. Okay. Now, once you're in the trade, there are 3 possible triggers that can trigger a signal to get out of the trade. And those 3 triggers, it's whichever one it triggers first, that's your rule to get out of the trade. So the first rule is if you have 50% of the max gain, it's time to take your profits and run. The second rule is if you've lost 100% of the max gain, cut your losses and get out. And the third rule is if the trade reaches 21 days to expiration and you have not hit your take profit level, or you have not hit your stop loss level, still get out of the trade. So either one of these 3 triggers, whichever one hits first, that's your rule to get out of the trade. Does that make sense, everyone? Please type 8 into the chat window if that makes sense to you. So just to give you an example, if we sold a $10 wide credit spread and we collected $4 for that credit spread, that means our max gain is $4. So whenever you make half of that, which is $2, it's time to take your profits and run. So if you sold something for $4, you can put in a limit order to buy it back at $2 debit, get out of the trade. If instead of going down to $2 and making your $2, the credit spread rises to $8, which means that you've lost 100% of your max gain at $8 debit, that's time to get out of the trade. Instead of waiting to have the full loss, get out at 100% of the max gain. And the third rule is, again, if it hits 21 days to expiration without triggering your take profit or your stop loss, it's also time to get out of that trade. Can you roll this trade? You absolutely can, but you do it on one of these three triggers. Either this trade is gone in your favor and you're ready to roll it and continue this trade, or the trade is going against you, but you think the stock is going to come back in your favor, then you want to roll it again. Or if you reach 21 days to expiration and you simply think that the stock will continue in the direction you expect it to, you can roll it, but do it based on one of these three triggers. If that makes sense to you, please type 9 into the chat window. And Sash is asking a great question. He's asking why, if the trade goes in your favor, do you take the trade at 21 days to expiration? It all comes down to avoiding assignment risk and exercise risk, because you can hold these trades to expiration, but at expiration, you have significantly higher early assignment risk, which means that the short strike gets assigned to you. That means that changes the risk of the trade once you get past the expiration date. And you have exercise risk at assignment, where sometimes, occasionally, it doesn't happen very often, but the option expires out of the money on Friday. Next thing you know, on Monday, the short leg was exercised. You didn't exercise your long leg and the stock is down substantially. And now you're at a substantially larger loss than you had anticipated. These are edge cases, but I have seen clients lose hundreds of thousands of dollars on a trade that they thought they had a max risk of just a few $1,000s because they held a trade like this to expiration. It's not very often that they happen, but the rules are in place to help you prevent those blowups or potential edge cases. So take your profits at 21 days to expiration. Please, this is designed to help you avoid these types of traps that could happen in your account. And lastly, even if you take nothing else from my session here today, the most important rule for traders to stay in their lane and build confidence and build your account sustainably is what we call the golden rule of risk management. And this comes down to a course that I normally teach that you can learn more about if you sign up for your free 30-day trial on the trading psychology of professional traders and the trading psychology of successful traders, because it comes down to changing your mindset as to how you think about trading. A lot of investors think of trading as wins and losses. You want to win as often as possible, but that's the wrong mindset, because there's a philosophy called infinite versus finite games. And you have games like basketball and chess where your only goal is to win at those games. And then you have infinite games like running a business or running a trading account, where there's no such thing as winning. There's no such thing as losing. You are either in business or you're out of business, just like how you either have an account that you can still trade with, or you've blown up your account where you can no longer trade. And when you're playing in an infinite game, what you recognize is that winning and losing doesn't matter. There's no such thing as winning or losing. So stop focusing on winners and losers. Focus on making sure that you can trade another day. And once you make this shift in how you think about your trading account, that's really where I see traders become far more confident, far more sustainable in the growth of their accounts. And there's one trick that you can force yourself, if you will, to think infinitely, even if you still think in these wins and losses column, if you will. And that's the golden rule of risk management, which is that the max loss of any trade that you make, especially a credit spread, never exceeds 1 to 2% of your total account value. So I have a table here of account values. And you can find yourself where you lie on the spectrum. You could have a $5,000 account, you can have a few $1 million account. Whatever your account size is, what you need to look at are these two columns. So let's say you have a $50,000 trading account. What you want to look at is this $5,000 to $1,000 number. The max loss on a credit spread that you sell should never, ever exceed that number. If you exceed that number, what you open yourself up to is the potential that a few losing trades in a row will blow up a very large portion of your portfolio. And if that is to happen, what you're doing is effectively putting yourself the equivalent of out of business. Think about a store that puts themselves out of business. Once you're out of business, guess what? You can't get yourself back up unless you deposit more money. And we all have finite amounts of capital that we have to play with, which is why The goal of trading is not to win. The goal of trading is not to have more winners than losers. The goal of trading is to prevent yourself from going out of business. How do you prevent yourself from going out of business? Making sure that no single trade and no series of consecutive losses blows a hole in your portfolio. And if any of you can relate to this, where you had a string of losers, maybe it was a bad month, maybe it was March of 2020, maybe it was December of 2018, where just a bad month blew a serious hole in your portfolio. Please type 1 into the chat window if you can relate to that. And I know there's going to be a lot of you that's going to write ones, because I've been through this myself. I've worked with thousands of traders that have been through this. And even if you can't get wrap your head around this idea of I'm playing an infinite game and I'm trying to just prevent myself from going out of business, my goal is not to win. My goal is actually just to prevent myself from going out of business. There's this one rule that you can trick yourself into. And someone said, this is just like playing poker, one long game, don't go broke. It's exactly that concept. And, everyone has their different ways of learning this lesson. Some people are poker players. Some people run their own business. Some people, there's just different ways that we all learn this one rule, but this is the one rule that's most important to succeeding in trading. So let me just walk you through this. Let's say you have a $50,000 account and my max risk is $500 to $1,000. And what I'm trading here is my Cleveland Cliffs credit spread here. Okay. So what we have here at OptionsPlay is a very nifty tool that helps you calculate this. So let's say I want to risk no more than $1,000 on this particular trade. What our platform does is it calculates for you the number of contracts that you can sell on this Cleveland Cliffs credit spread so that the max risk of your trade does not exceed this $1,000. This tool helps you stay in your lane. And what happens is that, okay, so if the Cleveland Cliffs trade doesn't go well, and I have a few other trades similar to this and they don't go well, guess what? I could have 4 or 5 losers in a row. And now I've blown up, let's say $5,000 in my account, but I still have 90% of my account intact to continue trading. I'm still in business. As long as I'm in business, I can continue trading. The second I'm out of business, guess what? No matter how much the market rebounds, no matter how great I'm at picking stocks after that, I'm no longer in business, which is why it's so important to stick to these rules. So I hope that this session here today was helpful in giving you a better understanding of options trading, of these strategies, how you can use a platform like ours to find opportunities like this, and hopefully teach you a little bit about what I have learned over the past 15 years to help me and my traders become better at trading and building that confidence and building a more sustainable trading account with that. So what I want to leave everyone here with today is a special offer that we have for this particular webinar. And I want to thank everyone for taking the time out here this afternoon to learn and listen to me. And I love doing this. I do this every single Thursday with our members here at OptionsPlay. We break down a strategy, we teach you how to trade them, and we show you how our platform is designed to help you find and analyze these trades. So you can sign up for a free 30-day trial and get access to everything. There's no credit card needed using this link here on your screen, or you can click on the link that we just posted into the chat window. You get a free 30-day trial to everything and a 10% discount to a subscription if and when you choose to subscribe after the 30 days. And what I do is, we send out about 2 to 3 credit spread signals to our members a week. So these are actually handpicked by me and my team. So if you like what I've been doing on CNBC and you want access to more of those types of ideas, we send out at least 2 to 3 to our members every single week. Not only do you get the entry signals, you also get the exit signals. This way you know when we can get in, when you can get out. I'll show you my rationale between the technical and fundamental thesis. We'll tell you the symbol, we'll tell you the specific expiration date and strike price, and we'll show you based on the rules that I'm teaching you today when they generate the entry signal and when they generate the exit signal. And then every single week, I'm doing educational sessions. Tuesday mornings, I do a market outlook session. That gives you a high-level overview of how I'm viewing the macro picture of the overall markets. Every single Thursday, we do an options education session where we dive into specific strategies, just like credit spreads today. When we go through the strategy, we go through the best practices, and we show you the tools that we have developed to help you implement and trade these strategies. And then every other Friday, I do different sessions. I do rapid fire sessions where You as members will submit symbols, and I look at the symbols that you submit both on a technical and fundamental perspective, and I give you my notes afterwards so that you can see on the rapid fire session the 20, 30 symbols that I go through, which ones I like, which ones I don't. You get those notes so that you can take advantage of that. And then we also do a long-term investing thematic series. We're going to do one on working from home. We're seeing a huge shift into how people are going to work in the future. So next Friday, I'm doing a long thematic series on the companies that are going to benefit from how we shift our work to home. So a lot of things that you're going to get access to in your next free 30-day trial for those of you that sign up, in addition to the 10% discount that you'll receive if you choose to subscribe after those 30 days. So with that, that covers what I wanted to share with you here today. I hope that you guys find this useful in giving you a better understanding of credit spreads and how to utilize the tools that are here at OptionsPlay to help you find them, analyze them, and feel confident in making your own trades. So with that, what I'll do is I'll open this up for Q&A. There is a chat window and there's a Q&A window here. So if you can, please type your questions into your Q&A window, and I'll try to answer as many questions as I have time for before I have to drop for today. I assume we're going to let the T-Dot call expire worthless. If you're talking about a short call, the answer is yes, we will be rolling that. Again, there's a Q&A window and there is a chat window. Please type your questions into the Q&A window. And Peter, Donald, George, thank you so much. I really appreciate it. When to sell credit spreads versus buying call spreads, aren't they the same? Fred, they are far from the same. So here's a credit spread, here's a debit spread. Credit spread is on the left-hand side, debit spread is on the right-hand side. And just to show you, the two have virtually the same amount of risk, right? The debit spread here risks 852, the credit spread risks 832. They couldn't be further from the same. So let's say the stock doesn't move. The stock's just staying around 2286. If I sold the credit spread, I make $568. If I bought a debit spread, I lose $508. However, if the stock goes higher, let's say it goes up to 25, 26, 27. Here, I only make $568 because that's the most I can ever make on a credit spread. But a debit spread, the higher it goes, the higher the profits that I make. For the same amount of risk, $852 worth of risk, I can potentially make double that. I can even make more than double that. $2,300 is the max gain on a debit spread. So if I really think Cleveland Cliffs is going to go higher, would you sell the credit spread or would you buy the debit spread? I think it's very clear for most investors that if you're trying to trade this, it depends on what your directional view is. If you think the stock is going to move a little bit higher, you're much better off selling the credit spread. If you think the stock's going to make a big move, you're much better off buying the debit spread. Remember, the two strategies have the same amount of risk, at least in this particular scenario, right? The two strategies that I'm showing you have very similar risk profiles, but very different outcomes depending on where you think the stock's going to go. And even if the stock moves a little bit lower here, right? So even if the stock starts to decline, a credit spread will still be profitable. A debit spread will lose the full $852 here to the downside. So the P&L simulator, one of the most powerful tools, and really will be helpful for those of you that are trying to explore and learn different strategies to have a better understanding of the true risk and rewards before you execute them in your account. Have you done a spread on the VIX? We recently did one on the VIX, I would say in April or so, where we traded the July VIX spreads. We don't trade them very often. And the reason for me is the same reason that, trading bonds when you have a view on yields is a kind of a weird way to play it, right? So if I think yields are going to go from 150 basis points to 200 basis points, what does that move TLT from? The answer is you don't really know. You kind of have to do some back of the envelope calculations. And especially with the VIX, if I think that the markets are going to move lower by 10%, how much does the VIX go up by? The answer is you don't know. And I never like to trade things where I don't know how far the stock's going to move or how much an asset's going to move based on my view. So for those reasons, I'm not a big fan of trading VIX. I'd much rather trade the direct instrument itself. Sean is saying premium versus with column on that spreadsheet. Is that our gauge for over 33% to hit that ratio? That's exactly right. Our credit spread report is based on the percentage premium over with. The higher the premium versus the with, the better the ratio is in your favor of risk to reward. That is exactly correct. What day to enter, what day is the expiration to enter the trade? So based on our back testing rules, you always want to sell a credit spread that is roughly 45 days to expiration as your target days to expiration for a credit spread. 100% max gain or 200% of max gain? 100% of max gain. So the question was, when do we cut our losses? 100% of the max loss. So $4 is your max gain. So if $4 goes up to $8, that is a loss of $4, which is 100% of the max gain. Is there any benefit to holding a credit spread until expiration if you are way ahead? No. If you're way ahead, you're far better off locking in those profits and then taking that same capital that you've locked up or that you would have locked up if you stayed in that trade and apply to the next trade. Because especially, many times, let's say you collect $4, right? And immediately the trade goes down to $1. So you've already made 75% of your max gain. Remember, you're tying up the other $6 here to stay on this trade. And what happens is now your potential risk reward is far worse because now you're still risking the $6, but now you can only make an additional $1 for it. Your cost of capital at that point is far less efficient. You're basically still tying up the same amount of money now to make a much smaller amount of money, and you have at risk that the stock turns around. So especially when you're ahead, that's when it makes the most sense to take those profits and apply that $6 to the next trade where you can make another, $2, $3 on the back of that, as opposed to tying it up and keeping it in this trade where you can only make $1 more extra for that. It's all about the cost of capital and what is the most efficient use of your capital. I hope that answered your question. Who was that? That was Sean. Gary saying, thoughts relative to entering with expiration after earnings. Thoughts relative to entering with expirations after earnings. So, I've done my fair share of trades on this with earnings and without earnings. Honestly, the only difference between an earnings play and a non-earnings play is that with an earnings play, you should have a fundamental reason as to why you believe that the stock is going to move in one particular direction. That's usually, for me, based on a combination of relative strength and fundamentals. For those of you that have followed me enough on CNBC, you know that whenever I do an earnings play, I always look at relative strength and I always look at the fundamentals. If the view is in line and I'm getting a fair amount of credit, I usually, for earnings plays, I try to collect at least 40% of the width. If I'm not collecting 40% on the width on an earnings play, I usually don't think it's worth it. That's my view. A follow-up to my email that you answered to. So if you have $50,000 and keep it at 2% per trade, would that mean you could have 50 trades open? No, you should not have 50 trades open, because if all 50 trades go against you, you've now blown up 100% of your account and you're out of business. The whole goal is to prevent yourself from going out of business. I usually tend to find that most traders should not have more than 5 to 6 open trades at a time if you're risking 2% of your total account value, which means that a bad month is going to wipe out 10% of your account, and you still have 90% of your total portfolio to stay in business and trade another day. Who do I reach out to issues logging on with the site? So Marty, the best place is to directly on the platform. You have this link here where it says questions, ask us. Click on this link and that will be the best way. Otherwise, you can send us an email at info@optionsplay.com. When closing the trade, which leg should you close first? You should always close a credit spread, both legs at the same time. You should never trade them separately. Always open them as one strategy and close them as one strategy. Never break it apart. Stephen is asking, if max profit is $4, then I'm assuming that is what you are collecting when creating the spread. Yes. However, to get out at 50% or loss at 100%, Do we have to constantly look up and calculate the buy price and sell price of both positions, or does the broker have one price listed as a vertical spread? So Stephen, I don't know about your broker, but actually I take that back. Every broker, when you trade a spread, will have one price. So you will never use two prices. You're only looking at the net price of the two legs. You don't really care where each leg gets filled. You only care about the net price. And sometimes you get wacky executions on both legs, but as long as the net price is what you're looking for, that is what's going to give you what you need. Signals for debit trades as well. So Gopal, signals for debit trades are much, much harder because you need to have a very strong directional view. And those usually cannot be done algorithmically. Strong directional views must have a bit of a, I would say, a human touch to it, if you will. It's based on technical, fundamental factors, timing. There's just, an algorithm can't do it. So that's why for debit spread trades, we do send them. About 15% of our trade signals are debit spreads, but there are far more nuanced. We currently have one on Okta. We currently have one on Uber, but those are more fundamental based. Those are things that me and my research team handpick for those particular trades. We did well this morning on Lockheed Martin put spread. Alex, yep, we currently just closed out a Lockheed Martin put spread here this morning for a profit. Does your platform do trading as well? So no, we do not do trading. When you click on the trade button, this is how you enter the trade into your broker's platform. You can enter this directly into your platform with the instructions on your screen. For an ETF credit spread, if I'm at max profit target, is it better to let it expire or sell it Friday before the close? I always advocate that you close it before the close. Otherwise, you have exercise risk on that strategy, even if it expires out of the money. How would you compare the scanner and OptionsPlay versus the spread hacker on Thinkorswim? So the spread hacker on Thinkorswim is very powerful, but what we're looking for is something very different. We're looking specifically for a percentage of the width, and that's not something I believe the Thinkorswim spread hacker can find. The spread hacker is based on probabilities, generally speaking. But I haven't used a spread hacker in quite a few years. I'm actually curious as to whether or not you could replicate something like this with a spread hacker. I'm unclear as to what. The other thing you have to consider here is that we are layering other things like liquidity and directional view on top of this. So we use our proprietary trend indicators. We use our proprietary signal generation to filter out most of the symbols. As you can see, out of the few thousand symbols that you can trade, there are only a handful of ideas because most of them are filtered out based on liquidity and based on direction. So that's the one thing that you're not going to get from the spread hacker on Thinkorswim. I'm unclear as to why to exit at 21 days to expiration. Alexander, it's all about removing early assignment risk. When you sell a credit spread where the short leg is close to the current price of the stock, you have risk of early assignment. Once you are assigned early, many times most investors don't have the capital to hold on to that trade. You basically have to exit the trade, and you don't want that, right? You don't want to be forced to exit a trade. That's why you close at 21 days to expiration, and in the last 3 weeks of expiration, you have higher gamma risk. So what you're trying to do is reduce that gamma risk by buying it back at 21 days to expiration. The sweet spot between getting enough theta decay, but not a much gamma risk, is in that 45-day to 21-day window. And that's why those are the times that we sell a 45-day and we buy it back 21 days to expiration. Anar, all of our previous sessions are recorded. So for those of you that are members, you have access to all of our previously recorded sessions. We have our market outlook sessions. We have our options education session. We have our members only content. This is all available to you during your free 30-day trial. Would you take a 30 delta and lower delta opposed to 50 and 25? You can, David. The returns are lower. You get a higher probability of profit. But like I said, the goal here is to try to find credit spreads that collect as much of the width. The lower the delta you go, the less chance that you will ever find a credit spread that collects 1/3 of the width. When you go down to 30 deltas, you can almost never find something that collects 1/3 of the width. You're lucky just to find something that collects 1/3 of the width. You have to get to that 50-25 delta because it really doesn't matter what deltas you use. What you're trying to do is make sure that whatever you collect, you're never risking, you're not risking more than 1.5 times what you can potentially collect. So who cares what deltas you use? You're trying to find ones that have the highest probability, the best risk reward in your favor, because the whole goal is so that when you're wrong, because we never know when you're going to be wrong, we know we're going to be wrong sometimes, but the goal is that when you're wrong, you wipe out as few of your previous trades as possible. When you go to lower deltas, it's not going to be this extreme, but it's going to be something along these lines. For every $1 you risk, you might be risking $4. For every $1 you collect, you might be risking $4. And that's just going to be a hard number. That's just going to be a hard trade to overcome. Whenever you lose 4 times the potential income that you make, you have to win far more often just to keep pace. So that's why it's important to use these specific deltas. Can a version of this model be applied to ETFs? You can, but you're not going to collect 1/3 of the width. ETFs, we tend to find you collect about 27 to 30% of the width, generally speaking. The AAP 190-180 credit spread you gave on air is doing well. Thank you. So Tony, we actually took profits on that trade. We talked about it last week on air, and I also sent a signal to our members. So if you were a member, you would have received the signal to take profits on that trade. If you're still in that trade, I do recommend that you take profits on it. Are there times when it's advised to split your spread, close out one leg at a time? No, Fred, I do not recommend that you ever split up your spread. How come sometimes a stock has a score of 10, but the score on the option is low? So the two are completely different scores, Saul. The score on the stock is really just the direction of the stock. That's it. It has nothing to do with the option, right? So if a stock is in a clear, strong uptrend and outperforming the market, it's going to have a very strong score. But that has nothing to do with how cheap or expensive the options are. So the OptionsPlay score and the technical score are two separate things. That's why they don't have the same score. Thank you. This was one of the best classes I've sat through in my short journey with OptionsPlay. I love the flow with the class and the use of the website to reinforce learning and using it properly. Thank you so much, Sean. I really appreciate that. If for a BP, I'm guessing a bull put, if I get assigned the shares, dividend comes into play as well from the stock ownership. That is correct. But I would say most people selling put credit spreads do not want to be assigned and may not have the capital to be assigned on that trade. Can you tell me one more time the deltas of long and short of the credit spread? It is the 50 and the 25 delta on a credit spread. Sell the 50, buy the 25. Do you do more credit spreads versus debit spreads? I would say I do about 4-to-1 credit spreads to debit spreads. Again, debit spreads are only for when you expect the stock to make a large directional move. And it's not every day that you find a stock that you believe it's going to make a quick and fast move in a defined amount of time. So that's why far more credit spreads than debit spreads. Does the platform provide trades for SPY, SPX? We do it for SPY. We don't have SPX. We do NDX, NQX, and XND, the 3 NASDAQ 100 index options. ETF options trading, the best strategy is iron condor. I don't think there's a best strategy for anything. If there was a best strategy for anything, that's the only thing anyone would ever trade. It's all about what makes sense for you. Iron condors are suitable in certain market environments, and ETFs are certainly a product that you can trade iron condors or, but I don't think there's any strategy that's best for one specific symbol or one specific asset class. How do you typically find stocks for candidates for credit spreads? Alan, we use our credit spread report. Our credit spread report finds these candidates for us. It does the work for you. It scans the market. It finds the stocks that are liquid. It does the work in terms of looking for skew and giving you where the skew is in your favor and lining up the directional view. So I use our credit spread report to find candidates for selling credit spreads. Can you use your service to trade indices? Yes, but we're limited currently to NDX, NQX, and XND. How do I keep track of all the exit parameters for each trade? Does your software do it? So Todd, we do it for the trade signals that we send out. So for example, when we send out the AAP, as you can see, I know that I'm up 63%. That's time to take profits. JP Morgan, here's one that's down 120%. That's time to cut losses. So yes, our platform does do this. In about a month's time, you're going to be able to track your own portfolio here as well. So it is something that we help do. What deltas do you use in a bear call situation? The exact same deltas for a bear call. What's your earliest you can close a credit spread? As you know, the earliest that you typically sell a credit to close a credit spread is usually about, I would say 2 to 3 days. Sometimes the trade just goes in your favor immediately. You start to make 50% of the max gain and you take profits. But usually, 3 to 5 days is usually the quickest that you'll close out a credit spread. Would a 50 delta imply a 50% chance of winning? No, the chance of winning is higher than 50 deltas because your chance of winning is better than the break-even point, not better than the short strike. So you have a 50% chance of expiring out of the money at a 50 delta, but you actually have a higher probability of winning because you just have to beat the break-even price. So I imagine there are ample trades using these parameters. Yeah, so every single hour, we tend to find that we can find at least a handful of trades, usually more than enough for at least me to trade, to search for, out of these top few trades. Do you ever roll a position to a futures date if the trade goes against you? I'm not a big fan of turning one loser into another loser. If I get the directional view wrong, this is the part about, thinking about an infinite game. I see a lot of traders that have a small loss. They don't want to lose it. So they try to roll it into the next trade, hoping that they're going to be able to make it back. And that's really where you're being too short-sighted. You're not thinking about trading as an infinite game. You're thinking about trading as a finite game where you're still focused on wins and losses. There's no such thing as wins and losses in terms of running a business or trading your account. It's about staying in business. So yes, you can roll a trade, and occasionally, very, very rarely do I do that. I would say that I don't think I can actually remember a trade that was a loser that I ended up rolling. I only roll my winners because it makes sense to roll your winners. Why? I can't tell you the amount of emotional toll that people put themselves through by trying to take a loser, rolling it, and hoping that they get their money back, only to see that loser potentially lose even more. Why put yourself through it? I don't, it's something that you have to get your head around. But once you do, and you realize that you should just let go of your losers and focus on your winners, focus your emotional efforts and your energy on turning winners into bigger winners rather than small losers back into winners, it'll change your life in terms of how you deal with trading, winning and losing. So I highly recommend for you to sign up for, my course on trading psychology. It's going to be very helpful for those of you that are just starting out. What is the danger of playing weekly credit spreads versus 45 days out? The danger is just the early assignment and the higher gamma risk. You have a trade that looks like it's going to win. Next thing you know, the stock moves even 50 cents against you and it turns into a big loser. You just have much higher gamma risk when you're selling weekly spreads. Which is your favorite credit spread, bear put or bear call? Well, by far bear put, because the markets drift higher 60% of the time. Statistically speaking, bear puts have a far greater, a higher chance of success than a bear call. Is there a situation where you use weekly options instead of 45 days out? No, the weekly option trades does not provide higher returns. A lot of people think that higher weekly options, you're going to collect more premium, but think about it. In a 45-day period, you'd have to sell about 6 weekly options. So you're increasing your transaction cost 6 times. You're paying the bid-ask spread 6 more times. You're paying the commission 6 more times. Whatever edge you think you're collecting by doing weekly options over a 45-day option, I guarantee you adding 6 more transactions on top of that will greatly wipe it out, if not even more than that. And likely you are going to underperform selling weekly options every single week than selling one 45-day option because of the increased transaction cost that you're adding. How do you repair a broken trade? You don't repair a broken trade. You let the broken trade break and move on to the next trade. Repairing broken trades is there's one of two options. One, the trade sometimes you manage to successfully repair a broken trade, but there is also plenty of other times that when you try to repair a broken trade, you take on a larger risk. So you end up not risking 2% of your account on the trade, you end up risking 4%, 5%, 10%. And sometimes people don't ever learn their lesson and they try to repair the broken trade that they tried to repair, and they find themselves in much, much bigger holes. And I cannot tell you enough how many times people have done this and blown up their accounts. So stop trying to repair broken trades. Let them go. You're going to have losing trades. That's okay. You're never going to be able to get every trade right. The sooner you can learn to let those go, the better you will become as a trader. Why do you not let a losing trade go as far as 100% of max gain? Because it's all about tying up capital to lose more money. Why tie up the capital, lose that extra $2? The chance of a credit spread that has lost 80% of its max gain coming back to any type of profit is very, very slim. So you basically are guaranteeing to lose more money, and during that time, you're tying up capital that you can apply to the next trade. So it's all about not losing, protecting some profits if possible, but more importantly, making sure that you're taking the capital and applying to a better trade. Do you usually set up the expiration date 30 days? No, 45 days to expiration is the rule of thumb that we use. Do you have similar rules to get early out from a cash covered put? A cash covered put, you usually don't want to get out early because you want to own the stock. That's why you sell a cash covered put. So no, I do not have the same rules. Tony, I'm just checking emails and you didn't send the AAP alert to close. Alex, I'll check on that. Send me an email at info@optionsplay.com, but I'm pretty sure I did. And I believe it was either Wednesday or Thursday of last week. Is IV rank available in brokerages like Thinkorswim? It is. It's called IV percentile in Thinkorswim. Is it okay to sell open credit spreads before market opens? Do not sell credit spreads before the market opens. Wait till the market opens, see what the opening bid ask is, then place your orders relative to that bid ask. Do not place orders before the market open. Why do you let a losing trade go as far as 100% of max gain? Why not earlier? Simply because you're going to get stopped out on trades that would have went back in your favor. You want to have a deep enough of a stop loss so that you don't get stopped out too early and have the trade then just go right back in your favor. Rule of thumb is never to break a spread into individual legs. Yes, never break a spread into individual legs. Thank you for this. Even though I have seen your other videos, this one nailed down some of the rules that I haven't been following. Definitely getting a lot of new members, including myself. James, thank you so much. I really appreciate it. Do you ever fix a losing credit spread or rolling out or creating an iron condor? So trading an iron condor doesn't fix a losing credit spread, right? Because the amount that you're going to collect on the other side is not going to offset the losses that you've made on a credit spread. It'll reduce the losses a little bit. And if the trade then comes back in your favor, you have the potential of getting yourself to a smaller loss or potentially even a small win. But you can do that. But again, the question is, should you continue to tie up the capital on that credit spread, or should you let that go, just let go of the loss and and use up the capital for a better trade? Is there ever a time when using a credit spread is not optimal? Yes. When you think the stock's going to make a big move, credit spread is not optimal at all. As I was showing you before here on Cleveland Cliffs, if I think the stock's going to make a big move, would I rather for the same amount of risk, $800 or so, make $2,300? Or would I rather make $568? Far less optimal to sell a credit spread if I think the stock's going to make a big move. Far better to buy a debit spread. So you should not just use credit spreads blindly every single time. You should only use it when you think that there is a fairly a mild move. Gopal, with your discount, the monthly fee, I believe, is $990 a month or $660 a month. It's a 10% discount off of $100 a month or $750 a year. Sakal, you're very welcome. Okay, that covers all of the questions that you guys have submitted here today. So again, I hope that this was helpful in giving you a better understanding as to how to utilize our platform, how to find opportunities here in this particular market environment. And again, I hope for those of you that are starting out here or just checking us out, sign up for a free 30-day trial. It's completely free. There's no credit card needed. It gives you full access to everything that I showed you here today for 30 days, including my course on trading psychology, and hopefully gives you a sense for how to trade credit spreads going forward. Access to the reports, analyze them using the OptionsPlay platform, receive some of our signals, some of our education, and decide for yourself whether this is a service suited for you. With that, thank you so much. This session is recorded. We'll send you the recording as soon as we finish here today so that you can follow along at your own pace, review the rules, and hopefully I will see you here on our next options education session, which is this Thursday. We're going to talk about how to grow a small account sustainably. So for those of you that sign up for a free 30-day trial, you'll be able to access that session here this coming Thursday. And then next Friday, I'm doing that thematic session on working from home, talking about the long-term opportunities I see in the markets and which stocks I would utilize to play for the long-term shift that we're making to working from home. With that, thank you so much. Have a great evening, and I'll see you guys here on Thursday.